Dive into the world of investing with the classic book, The Intelligent Investor Rev Ed. This timeless treasure is more than just a book. It is a guide, a mentor, and a friend to those who are keen to navigate the intricate maze of investing. The book's reputation as a definitive text in the field of investing is not unfounded. It is the brainchild of Benjamin Graham, a man whose name rings loud and clear in the world of finance. Benjamin Graham's influence is not confined to the pages of a book. He was a mentor to many, including one of the most successful investors of our time, Warren Buffett. Graham's teachings, his wisdom, and his strategies have stood the test of time. His understanding of market dynamics, his insights into human psychology, and his unwavering faith in value investing continue to guide investors worldwide. Let's set sail on the journey of investment wisdom with this timeless masterpiece. Chapter 1 lays the foundation by differentiating between investing and speculation, a critical distinction that forms the basis of your journey as an intelligent investor. Investing, as the author defines it, is a methodical strategy of creating wealth over time. It's about making thoughtful decisions, based on a careful analysis of an asset's intrinsic value and potential for long-term growth. On the flip side, speculation is a game of chance. It's akin to betting on the fluctuating prices of assets, often driven by market trends or rumors, rather than their real worth. A speculator hopes to make a quick buck, but such an approach is fraught with risk and uncertainty. The author emphasizes the importance of being an investor and not a speculator. It's about building sustainable wealth, not chasing fleeting opportunities. It's about understanding the value of patience, consistency, and thorough analysis. Remember, an intelligent investor always invests, never speculates. In Chapter 2, Graham tackles the often overlooked factor in investing, inflation. This silent enemy can chip away at your investments without you even realizing it. But fear not, Graham offers some sage advice on how to defend against this invisible foe. He emphasizes the importance of considering inflation's impact on your investments. Picture this: you invest $1,000 in a bond with a 3% return. Sounds good, right? But if inflation is running at 2%, your real return is only 1%. To combat inflation, Graham suggests investing in assets that have the potential to increase in value over time. Think stocks or real estate. These assets can provide a hedge against inflation, protecting the purchasing power of your money. He also advises diversifying your portfolio. This means spreading your investments across different asset classes, reducing the risk of any single investment being significantly affected by inflation. Inflation may be an investor's silent enemy, but with Graham's strategies, you can turn the tables. Chapter 3 provides a historical perspective of the stock market. A journey through time, if you will, where Graham paints a vivid picture of the market's ebbs and flows, its highs and lows. He uses a century's worth of data as his canvas, illustrating the patterns and trends that have shaped our understanding of investing. In this chapter, Graham emphasizes the importance of learning from the past. He argues that an understanding of market history is not just a nice-to-have, but a need-to-have for anyone serious about making informed investment decisions. This knowledge, he suggests, can help investors identify opportunities, navigate uncertainties, and avoid repeating the mistakes of the past. Graham's historical analysis of the stock market is not about predicting the future. No one can do that. Rather, it's about gaining insights and perspective, about learning to read the signs and signals that the market sends our way. History may not predict the future, but it certainly illuminates the path. In Chapter 4, Graham delves into the concept of portfolio management. He emphasizes the importance of balance and diversification in any investment portfolio. According to him, holding a mix of different types of investments can help to spread risk and increase the potential for returns. Moreover, Graham suggests that investors should not put all their eggs in one basket. Instead, they should spread their investments across various asset classes such as stocks, bonds, and real estate. This approach helps in reducing the impact of any single investment's poor performance on the overall portfolio. Graham also stresses the importance of risk management. He believes that understanding and managing risk is crucial in investing. This includes being aware of potential losses and having a plan to mitigate them. In essence, Graham's philosophy on portfolio policy is centered around careful planning, diversification, and risk management. Remember, a well-managed portfolio is the key to steady returns. Chapter 5 introduces us to the defensive investor. This breed of investor, according to Benjamin Graham, is one who is not interested in spending a significant amount of time on their investments. Instead, they prefer a more passive approach, looking for safety and freedom from bother. Graham provides a clear strategy for these investors. He suggests a diversified portfolio of high-grade bonds and leading common stocks. Graham also underscores the importance of patience and discipline because defensive investing is not about making quick profits. It's about steady growth over time. The defensive investor, Graham advises, should be resistant to market fluctuations. They should not be swayed by the market's siren songs of quick riches or panic-driven sell-offs. Instead, they should stick to their plan, remain patient, and let their investments grow at their own pace. Defensive investing isn't about avoiding risks. It's about managing them. To wrap up, let's summarize the key points from The Intelligent Investor Rev Ed. We've journeyed through a trove of insights, so let's revisit the highlights. Chapter 1 brought us the crucial distinction between investment and speculation. Remember, an investment is an endeavor promising safety of principal and an adequate return. Speculation, on the other hand, is a gamble based on market fluctuations. The book strongly advocates for the mindset of an investor, not a speculator. In Chapter 2, we delved into the relationship between the investor and inflation. It's vital to understand that inflation erodes the purchasing power of money over time. Therefore, an intelligent investor should aim for an investment return that outpaces inflation. Chapter 3 took us on a historical journey through a century of stock market history. The takeaway from this trip is that while the market has its ups and downs, it has an upward trend in the long run. This underpins the book's philosophy of long-term investing. In Chapter 4, we learned about the general portfolio policy. A balanced portfolio is key to weathering the storms of the market. The book recommends a portfolio split between high-grade bonds and diversified stocks, allowing for both security and growth. Chapter 5 introduced us to the concept of the defensive investor. This type of investor aims to protect their principal and earn a steady return. They avoid high-risk investments and focus on high-quality, diversified holdings. In essence, The Intelligent Investor Rev Ed imparts the wisdom that investing is not about getting rich quick. It's about understanding the markets, being mindful of inflation, maintaining a balanced portfolio, and having the patience to let your investments grow over time. It's about making thoughtful, informed decisions and standing firm in the face of market fluctuations. Investing may seem complex, but with the wisdom from The Intelligent Investor Rev Ed, you're well on your way to financial success.